Good morning, everyone. Welcome to the Gulf Intelligence Global UAE Energy Forum, where our overall theme for the day is the energy outlook for the year ahead. Of course, we're kicking off this morning with one of our first lectures in our Asia segment, and then moving across the day to the Middle East, Europe, and the US. Well, you'll be able to log on to Zoom for the sessions, or you can also feel free to watch them on LinkedIn, where we'll be broadcasting these all live throughout the day. I'm Brian Coslino from Gulf Intelligence. I'll be the facilitator for this session, which is essentially going to be broken down into two parts. The first part will have a 10-minute lecture, and then for the second parts, we'll have 10 minutes to open it up to you guys, the audience, for Q&A. Of course, feel free to use the chat box, enter any questions that you'd like. We'll moderate it throughout the session, and we'll try to answer as many as we can before we have to close. That being said, I'd like to introduce our guest lecturer for today, which is Mr. Joseph McMonigle, who's the Secretary General for the IEF, the International Energy Forum. He'll be giving his lecture on the outlook for the energy investment crisis in a post-COVID-19 year ahead. That being said, Joseph, I'd like to hand it over to you for your lecture.
Well, thanks a lot, Brian. Thank you to Gulf Intelligence and the other hosts for inviting me to participate in the Global UAE Energy Forum, hosted under the patronage of His Excellency Suhail Al-Mazuri, the UAE Minister of Energy and Industry. It's also great to be back with my friends at Gulf Intelligence. This event coincides with policymakers and the energy industry facing the monumental challenge of having to make long-term decisions so soon after last year's market upheaval. COVID-19 continues to cloud short, medium, and long-term energy outlooks. And that's not the only challenge. We're also seeing investment deferrals and project cancellations, as well as increased regulatory uncertainty stemming from new and more diverse policy initiatives. And as vaccines proceed and the world unlocks in the post-COVID era, energy demand will return faster than supply, as the main energy outlooks show. Additional threats include lack of policy dialogue, collaboration, and robust market data. Each of these can hamper the energy sector investment and trade that's needed to revive the sustainable and inclusive growth that we need. To that end, the IEF, and in partnership with the Boston Consulting Group, BCG, recently released a report highlighting the looming investment crisis. We highlight the challenges posed by the lack of investment and divergent energy and climate policies toward the oil and gas sector. This threatens both market stability and the prospects for higher rates of economic growth. The report was our way of putting out a large proceed with caution sign. First, on the investment side, in response to low demand and low prices, oil and gas companies have reduced spending on developing new production. Our report found that oil and gas companies cut capex by 34% in 2020. And indications thus far point to continued cuts of 20 to 30% in 2021, this year. While these cuts help preserve balance sheets, they also bring many challenges. Without continued investment to offset natural declines in production, lower supply in the future may increase market volatility. And that could tighten market balances faster than as indicated in forecasts. It's also important to understand that this is not a cycle, but a shock. Moreover, unlike cycles of lower investment, our analysis found that every dollar of capex cut today would reduce activity by twice as much compared to the low oil price cycle of 2014. Therefore, capex cuts now have a much greater effect than they used to. Notwithstanding the huge efficiency gains that digitalization and new technologies have brought, industry must become more efficient just to catch up, let alone return to growth in a rapidly changing policy and market environment. To be more specific, our analysis shows that by 2030, investment levels will need to rise by at least $225 billion US from 2020 levels to avoid a crisis. This requires policy cohesion and adequate market incentives for investment to recover. When it comes to recovery in oil demand, there are differing outlooks, though neither OPEC nor the IEA believe that demand will peak in the next 10 years. So, in a post COVID market environment, lower supply will lead to prices trending higher, and there will be greater market volatility as Asian gas price markets already show. Higher and more volatile oil and natural gas prices would only compound the challenges faced by a post COVID-19 global economy, including slower economic growth and higher rates of energy poverty. Price volatility would also dilute investor confidence in the ability to achieve climate and sustainable development goals with the timeframes outlined by the UN Agenda 2030 development goals and the Paris Agreement. Limiting capital to the oil and gas industry interferes with its ability to deploy new technologies like offshore wind, hydrogen, and carbon capture, use, and storage at the scale needed to achieve shared goals. Additional challenges include layoffs in the industry and research and development spending cuts. Each of these will discourage the next generation of talent from looking toward a career in the oil and gas industry at the precise moment when their skills are most needed. Unwanted boom and bust prices will create hurdles to achieving climate and development goals. Adequate investment incentives and open trade flows must be secured through ongoing dialogue informed by comprehensive market data. As the world unlocks, demand will continue to grow faster than supply as short-term outlooks show. Across Asia, where lockdowns have been strict but shorter lived, demand has returned to near 2019 levels, and growth will likely return to trend soon. Factors that may further complicate investment decisions are diverging policy priorities and technology pathways, coupled with inconsistent approaches to the oil and gas industry by governments across the globe. To safeguard robust and predictable trade and investment conditions across densely interconnected energy markets and jurisdictions, there is an urgent need to deepen understanding of ESG criteria, regulations, and other market signals. There is also a need to ensure that technology choices are on open and competitive markets, and that environmental criteria and social governance standards, the E and the S of ESG, obtain equal status. The IEF producer-consumer dialogue takes a global view of these matters. We welcome the outcomes of last year's G20 energy ministers and the G20 leaders virtual meeting in Riyadh. That meeting reflected the latest consensus on the environment, energy, and climate. The G20 endorsement of the circular carbon economy helps to create consensus among the world's largest producers and consumers on the need to scale up investment in holistic approaches to carbon management, ranging from carbon capture, use, and storage to hydrogen beyond renewables alone. I'm encouraged by the policy objectives and the industry initiatives focused on recovering from the COVID-19 pandemic. They will help revive sustainable and inclusive economic growth, and they point toward a new energy and climate solidarity among producers and consumers. These developments can help accelerate orderly and inclusive transitions on open and interconnected energy markets, while also expanding access to affordable energy and spurring progress towards climate goals. Let me conclude by getting back to my proceed with caution sign, which should really be a set of warning labels applied to investment decisions. The message should be that failing to invest now brings several risks. Oil and gas supply demand balances tighten when demand returns faster than supply. Energy market volatility, including price spikes that undermine economic recovery. Layoffs and reduced R&D spending that discourage the next generation of talent and limit the industry's potential to drive change. Social disparities that widen as energy poverty grows. And finally, global energy security that is compromised by supplier consolidation. The IEF stands open and ready for the continued energy dialogue surrounding the COVID-19 and other challenges facing the energy and global community. To further advance the dialogue, please join us at the 11th IEA IEF OPEC Symposium on Energy Outlooks that the IEF will host this year virtually on February 17th in Riyadh. And that concludes my remarks, and I turn it back to you, Brian, for the rest of the program.
Thanks, Joseph. Again, we'll open up for Q&A. Everyone attending can feel free to ask a question, and we'll try to address it with the time left. But kicking off, I'd just like to ask one question. As you're seeing international oil companies slashing capex, but also at the same time, many national oil companies, for example, in the Middle East, are increasing expenditure. What can be some of the consequences of this divergence? What do you see? How do you see that dynamic evolving, and what would be some of the outcomes because of that?
Yeah, well, first of all, I think this is a new development. Really, the capex cuts early in 2020 were also private sector and state-owned. Not all of them, but a lot of the state-owned companies also announced the various investment decisions, curtailing investment decisions, out of cautious outlook for what the uncertainty that the market showed throughout the year, and actually, quite frankly, still shows. And I'm really happy to see that the NOCs are actually leading the way to renew investment again. I think it's really important, and I hope that will spur private companies to continue. One possible outcome that I think I touched on in my remarks is with regard to global energy security. And essentially, what you will have if only the state-owned companies are investing in new supply, the balance of power sort of shifts to them in terms of market forces. And so, I think from the global community perspective, I think it's important for the world to be rowing in the boat at the same time, and for us, and quite frankly, we're going to need, OPEC and the state-owned companies can't do it alone to meet this faster demand. We're going to need the private sector companies from non-OPEC sources to step up as well.
And you touched on of course, the energy investment crisis in terms of skill shortages. Can you just go into that a little bit more in terms of how this is going to impact the industry's ability to not only retain talent, but also attract, let's say, much needed, highly skilled employees and crews in the future?
That's right. I mean, the energy sector in around the world has become a very high skilled workforce, and if you lose these employees, not just because of pandemic, but obviously the cuts to labor force by companies, I think is obviously detrimental, but also as these folks retire, you want to make sure you're replenishing the workforce. It's sort of a little bit like natural declines. You want to make sure you're keeping up with the natural declines in the workforce as well. And so it's really important that the sector continue to attract talent. There was an excellent New York Times story that interviewed some young people who are in the space, and they're quite sort of pessimistic about their opportunities now. A lot of it had to do with sort of a renewed focus on climate that they had been sort of interpreting as not something that would provide much of a future for them. But I think the exact opposite. I think what we're going to need are for these energy companies, these oil and gas companies, to become energy companies of the future. And the young people that are being recruited may not be working on oil and gas. They may be working on hydrogen or carbon capture and storage, or other technologies that might help the environment and the planet. So hopefully we can turn that corner.
And as you mentioned, the volatility in the market, and of course, we have the uncertainty um, in terms of when demand will fully come back. Can you just again touch on how you see the long-term impacts of this investment shortage on investment into major energy sector and infrastructure projects?
Yeah, I mean it's a serious problem, and I think the most startling figure in my remarks that I made was that we're looking at a similar type of capex cut for 2021. And 2 years in a row of capex cuts is really going to set the sector back. So I'm hopeful that companies will re-examine these investment decisions as we get through the year and it becomes more clear about what the outcomes of COVID with the vaccine, and as we start to see demand signals come back. Because the danger is, I think we're already seeing it in Asia and in China in particular, that their demand is already surpassing 2019 levels. And I think, we could look to China as sort of the lead of what will happen to the rest of the world as we recover from COVID. The world demand is going to come back, I think personally, a lot faster than a lot of the forecasts show at this stage. It's going to be very hard to just turn on supply again. So we're going to see, as I said in my speech, prices trending higher, but as you said, volatility, and volatility is just as evil to investment in the energy sector, because it may be good for traders. It's not good for the energy sector as a whole and for consumers. And the IEF is an organization of producers and consumers, and I think what we care about is market stability, and we want to see a situation where producers are happy, but prices are not so high that it's impacting economic growth. And it's never been more important as we climb out of the COVID crisis and try to have the global economy recover.
And in terms of that producer consumer dialogues, can you just go a little bit more into the role that IEF is playing in facilitating those conversations, as well as the initiatives you're implementing to bring more traction to the current potential crisis from the energy investment side?
Yeah, well, thanks for that. The IEF is the largest of the energy agencies. We've got 70 member countries, and I don't know if people know this, but the IEF was sort of formed really at the behest of the producers who wanted to have a forum to be able to talk to the consuming countries. And so it was an organization to bring IEA countries and OPEC countries together. Now, of course, as I said, it's 70 member countries, more member countries than OPEC and IEA combined, and it's the only forum where producers and consumers have a seat at the table. And to that end, in terms of activities that we're planning, I mentioned in my remarks the Energy Outlook Symposium that we hold every year, which in the energy community and in the media community that covers energy, it's obviously a big event, normally attended in person with key ministers that show up. We'll be doing it virtual, and I think we'll have some really headline type of speakers. But I like to call it sort of the battle of the energy outlooks, because we have OPEC and we have IEA, and we might even have EIA, someone from EIA come, and of course we'll have different industry outlooks. Their chief economists will come and speak about it. So we'll have a great sort of menu of various outlooks. And to tell you the truth, for the most part, they all coalesce and point in the right direction. I think we'd have serious issues if the IEA was showing one track and OPEC was showing another. And quite frankly, that's one of the roles the IEF has played, to try to work throughout the year to try to make sure that both groups are discussing various developments in the market, so that we don't have very divergent views on the outlook. So that'll be the first big event. And then, of course, late in the year, we'll do our energy ministerial meeting, which we do every 2 years because it's 70 energy ministers. You can't have them come every year. And this year, it's being hosted by Saudi Arabia. We were supposed to have it last year because of the G20, so we just postponed it to next year. And I know from ministers that I've talked to, they're all looking forward to doing an in-person conference as opposed to a virtual one.
Well, great. Thanks for your insights.